Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. I was new to the workforce in the 70s and felt the economic recessionary problems of 1974 firsthand, and then Fed Chairman Paul Volcker taking my home mortgage up in 1980 to close to 18%, but it wasn't until the 1986 crash that I felt the real financial pain that markets can insert into your life. Since then, I have lived through a lot of market turmoil that every 10 years seems to hit with increasing vengeance as markets have become extraordinarily more leveraged. I saw how every single newspaper has run something on the Dow Jones surpassing 36,000 last week on the basis it was predicted back in the 90s in a book called The New Strategy for Profiting from the Coming Rise in the Stock Market. The book, incidentally, was totally wrong. The reason stock markets are where they are today has nothing to do with the reasons the authors expected. Yet, every single newspaper article says something like equities being a market where patience is virtue and that in the long term equities will outperform. This is exactly the sort of thing I was reading prior to the dot-com bubble implosion. If there is a single message I like to leave in this session, is that investing is about 1, discipline, 2, risk-adjusted investment decisions, and 3, separating illusion from reality. We're going to spend some time on the next 45 slides on these three and attempt to connect them as they apply currently. Let's remind ourselves that the reason stock markets are so elevated come down to largely the consequences of factors such as quantitative easing, cheap money, walls of money, which in turn has fueled a whole series of secondary consequences and investment behaviors that make zero sense in a real world, such as the belief unprofitable companies are worth more than profitable ones and inspire the credulous to believe they can get rich quick from snake oil schemes like meme stocks and cryptocurrencies. It's a madness of crowd driven largely by the consequences of earlier actions. My experience tells me the trick is going to be recognizing what is real and what is not. As such, I'd like to talk about what I call the meme stock trading strategy and the subjects listed here. My perspective is the market feels vulnerable to an avalanche as markets tighten liquidity, monetary tapers begin, and rate hikes start. Market players are generally all currently greedy and euphoric, yet surprisingly also scared and fearful. They know somehow it will end, but just can't let go because of the perception of money still being on the table. Investors should never forget that it is the last 5% that is always the most expensive. It is a hard drug to kick when buying the dips has delivered guaranteed returns for so many players for so long who have never experienced anything else. Broadly, since 2008, markets have thrived on first, the belief in implicit ongoing central bank support for markets to avoid a confidence collapse too big to fail, systemic bailouts, and government equating stock market rises with their own success. Secondly, successive waves of quantitative easing money printing have simply inflated the price of all financial assets. The wave of money market bulls will believe has strengthened the market base, cushioning losses on the basis that when markets do slide and because there is so much buy the dip money available, they'll swiftly recover from any shock. The bottom line is that the markets need to understand risk and thrive on it, not be protected and mollycoddled from it. There have been massive changes in the underlying structure of the markets. The death of market making and risk taking by banks. The transfer of risk from large banks with their genetic credit DNA into a very much more diverse asset management and retail investors taking direct risk. Regulators think they have changed risk appetites. All they have done is shunt it under another carpet. The lack of experience across trading floors and dealing rooms at banks, investors, and brokers of market instability. Anyone under 40 in finance has never seen real market mayhem. A changing financial mindset from risk trading to risk avoidance, caused by regulation, compliance, and a process-driven approach to any aspect of finance the regulators think they can control. And then the gamification, if I can call it that, of investment into fantasy, even as fewer and fewer smaller stocks are covered by any real research. Long-term professionals feel the market is insanely overvalued, but until now has proven that what is insane can become much more insane, so you can't short it. Frankly, all price signals are just broken, and we could be in a crack-up boom possibly. Players who started trading the market since 2000 seem to all be under the influence of greed and FOMO, FOMO being fear of missing out. There is presently a huge panic to chase stuff since seasonality is strong and money is still free and available. All this reminds me of the fall of 1999. I got out of the markets then, which turned out to be too early. It was painful to watch stocks continuously climb through the spring and be told daily the mistake I had made. 18 months later, I was being told by the same people how perceptive I had been. It was neither. It was obvious what was going to occur, and it was not possible to know how much more it would rise and just how quickly it would fall. All I really had to know was what was ahead and not be greedy. Obviously, the latter part being the real problem. Let me quote one of the greatest traders ever, Stanley Druckenmiller, and what he did during the upside panic in 1999. And I quote, "I bought $6 billion worth of tech stocks, and in 6 weeks I had lost $3 billion in that one play. You asked me what I learned? I didn't learn anything. I already knew that I wasn't supposed to do that. I was just an emotional basket case and couldn't help myself. So maybe I learned not to do it again, but I already knew that." End of quote. What I'm saying here is that investing and trading is about discipline. It isn't about being smart. Usually what we need to do is quite simple, but we ignore the obvious in favor of our emotions. Druckenmiller entered as shown here. If he had just stayed within any normal regression, he would have been rewarded. His emotions got in the way of what had always made him money. Do we have the same thing going on now? Here's Bitcoin and Tesla leading the market. Here are two obvious channels for both. Knowing this, the decision is obvious, but I can assure you that few will heed it. Not for one moment am I saying both are not headed higher, near term, and there is money that might be in fact left on the table and money to be made. I'm saying it is about risk-adjusted investing. Let me now shift to separating illusion from reality. The giant lifts in the market, as I said earlier, has been built on cheap, available credit that has flowed into asset appreciation versus productivity investments. The vehicles for that asset appreciation have been dominated by technology within the adoption of passive ETF investing. The FANG stocks quickly came to control and dominated indexes and formed the basis in many different types of ETFs. Today we have TAM, currently led by Tesla. Microsoft, Apple, Amazon, Tesla, Alphabet, Meta, and NVIDIA are at 26.4% of the popular SPY instrument, and those same stocks are 50.8% of the QQQs. As the well-followed Nomura McCallicott says, and I quote, "It matters a whole heck of a lot when we see QQQ options posting gamma and delta in the 100 percentiles." End of quote. We'll get to this distortion in a moment. We began shining a light on how the disappearing stock float was changing and distorting the equity markets in our April 2018 LONGWave video. It is important to revisit this video to remind yourself of what has been steadily going on. It only got worse since making that video. The video can be found at the Meta SII site or on our YouTube channel. The link is shown at the bottom of this slide. Buybacks, reduced U.S. IPOs, and private equity ownership, which restricted the size of stock pools, was already in 2018 having a tremendous impact on the markets. It has only accelerated since. More critically, it was beginning to power what we referred to then as the ETF dynamo. The structural dynamic also has only gotten larger, much larger. This more graphically illustrates the deterioration in market volume since the financial crisis. Stock volume actually grew until the 2008 financial crisis, then abruptly headed lower, while stock prices have historically headed higher. The question is, how could this be? Yes, the stock pool is taking less stock buying to move it upwards, but it is now more than this. We'll come back to answer this question in just a moment, but first we need to recognize another development in the markets. This is the dramatic shift from buying stocks to buying options on the underlying stock. A record 538 billion of single stock options traded on the average day in October, including 894 billion on October the 29th as a single day high. The options market was 1.4 times the underlying share volume in October. The reason for this, besides gaining leverage, is how players today are using the options market. We have ETFs which must use options to protect their liquidity risk, be nimble when the ETF is more than a single index, and contains a broad array of stocks, and to add additional profits. Mem stock trading strategies, which we'll go into more detail in a moment. Short squeezes, which has become a staple of the market, which we have highlighted a number of times in previous videos, and the use by what is referred to as the plunge protection team. All of these and others are using options in a massive way. Going back to our question, it stands to reason, even if the volumes are extremely large in the options market, then volumes should also be large and likewise growing in the individual underlying stocks. But that's not the case. That could only mean that calls and puts are being written naked. They're not actually supported by actual stocks that are being pledged as part of the call or put contract. In effect, we have a counterfeit market, which will work as long as the players can always meet their obligations and accept the counterfeit. This is like banking, where your money is never there because it's been lent out. As long as there's no bank panic or run on the bank, everything works just fine. In this case, it could be any number of things that could trigger a miscue. Built on top of just using options are now all sorts of hedging techniques using sophisticated algorithms that maximize profits with hedges in place. These create skew walls. A skew is the price differential of options out in time and price versus current prices. These skew walls develop when large numbers of traders are all coming to similar trading decisions and what they are willing to pay for these future protection options. One of our S&P daily charts is shown here, where we have the key options levels updated for us by Spot Gamma that allows us to ensure our technical analysis aligns with the dynamics of option movements. It illustrates just how much options now dominate stock movements. Let's now put some meat on what all this means by discussing what has become called mem stocks and the mem trading strategy. Remember, this is only one way options are now controlling the markets and creating massive distortions. A mem stock is a stock that has seen an increase in volume, not because of the company's performance, but rather because of hype on social media and online forums like Reddit. For this reason, these stocks often become overvalued, seeing dramatic and drastic price increases in just a short amount of time. Here we see the growth in the mem scene, showing all call options traded based on a 20-day moving average. The U.S. speculative trading volume gauge, as shown here, hit its highest in July. The most recent chart I have, but with little doubt, has exploded to new highs since July. This chart in late September shows large and small option traders are mostly buying speculative calls. What we are seeing is heavy call buying by retail as well as institutions is now back, if it ever left. Sentiment Traders notes that both are in the top 2% of all weeks since the dot-com bubble. They write, and I quote, "There were about 8 million options traded on Tesla last week. There were over 100 million call options traded on all stocks across all U.S. exchanges." End of quote. Traders are being told there is nothing wrong with buying calls, but it depends on how you're using those calls. Replacing longs with calls makes a lot of sense to us. End of quote. They're also being told markets are elevated, thus selling our out longs and replacing them with cheap calls is a rational trade, especially as volatility has stayed relatively low. They're also being told that hedging melt-up risk with cheap calls is another rational trade. Ourselves, we wonder if the pure speculative call options will evaporate due to theta burning quickly, should some of the hot names reverse or take a pause. Now, let's talk about the mem trading strategy itself. It obviously comes in many forms and continues to broaden and mutate. The mem-gamma strategy is basically about 1. Selecting thinly traded low-volume stocks to gain the greatest impact from this manipulation tactic. 2. Find a stock with relatively high put options volume. Send the word out to the group, your online forum of choice, to buy the stocks in mass. The raison d'etre of companies or places such as Robinhood, Reddit, Wall Street Bets, Yo-Yo, etc. Number 3, the sudden and coordinated unusual high volume buying raises the price of the stock since the number of shares outstanding is limited. This forces the put option holders to cover positions and join in the buying, or to hedge their put option positions by buying call options on the stock. 4. With the price gains in the stock, the mem-gamma bull groupies also buy call options on margin. This results in massive call option purchases, outlier volumes, which forces the underwriters of the call options to go in and buy the actual stock to protect their exposure. 5. Results in a high volume mega mass of buying energy in a low volume stock with limited stock outstanding, forcing an explosive short-term rise in the price of this otherwise uninteresting and boring stock. It's working and catching on fast. This sort of thing used to be illegal as nothing more than basic stock market manipulation. The law hasn't changed. The one thing I'm certain of is regulatory enforcement certainly has. It's like the U.S. illegal border crossing. The Fed just doesn't seem to care and appear to be just looking the other way. I need to stress the players involved in this are large and sophisticated. They're not the day traders of old who had few tools, skills, or analytics. Their screens look different than the day traders of old. They have control of the market and are taking it with them. The markets are delusional, unable to achieve price discovery, and almost totally manipulated without any impunity. Let me give you a couple of examples from last week alone. Let's start with Tesla. Here is last week's Tesla stock chart. Nobody has missed the Tesla call options bonanza. The simple leak that Hertz was going to buy large fleets of Tesla was all it needed, even though Elon Musk immediately twittered that no contract had been signed. The fact oil was rising only confirmed to Morgan Stanley what was ahead for Tesla. When I mentioned this to a knowledgeable friend of mine, he laughed, then proceeded to tell me it took 8 hours to charge a Tesla. He wondered if I knew that. And taking a trip was something he certainly wouldn't do with one. There may be charging stations, he said, but sleeping at the station while it charged, not the comfort of his hotel room, was something he didn't personally envisage. On Monday, October the 25th, Tesla stock had already climbed nearly 13% as option traders piled on bullish bets. The total premium exchanged hands during that week represented nearly 50% of the total single stock options. Bullish bets on call options accounted for 85% of volume. The soaring volume was primarily due to call options, which accounted for nearly 85% of the total premium transacted in SLA options. Fund managers that still aren't trading options in order to manage risk and take advantage of volatility are now simply dinosaurs. The biggest problem with current option traders is the fact that few have bothered reading Hull or Taleb. Most of them will learn what theta is the hard way, but it gets worse. Here is the chart for Avis. Obviously, the traders surmised if it was good for nearly bankrupt Hertz, it probably would be good for Avis to buy Tesla, and they attacked it. We used to call this pumping and dumping, but now we just call it mem trading. All this wouldn't be important, but Tesla is part of the TAM, and also included in the SPY and QQQ and Russell, etc. This takes the whole market with it. We wonder why the market just keeps on going and won't stop. It is interesting, as I'm doing this video, I hear Elon Musk in pre-market activity ask investors in a Twitter tweet whether based on the new taxation of high-income earners, which was passed on Friday as part of the $1.2 trillion infrastructure bill, whether he should sell 10% of his shares. The stock is down 5% from last week in pre-market activity. How is any of this investing? Especially when we remember there were massive options bets in highly shorted names such as GSX and IQ that Bill Hwang owned before his fund Archegos blew up. The games going on here are not just the mem traders, but big funds are doing this the same. And I stress that. It's more than just what we think as the small mem traders. Let me give you another example and linkage by building on this Avis spike we just looked at. On Tuesday, November the 2nd, the Dow Transport Index, a composite of 20 individual stocks, exploded higher, 2,307 points, 14.4% intraday, and closed up 1,096 points, or 6.7%. Only 35% of its component stocks rose. 65% declined. So how did this happen? The Gamma Bull traders gathered together to push up the price of Avis to a level that forced massive short covering, forcing those most pessimistic about the stock, because it, frankly, is quite pessimistic, to join them in a mem group buy tsunami. Avis opened at 171.46 and promptly tripled in value within the first 90 minutes of trading, eventually closing at $357, doubling its value in one day. Because the Dow Transport Index is a price-weighted index, as are the Dow Industrials, the doubling of Avis in one day was responsible for 1,132 of the tranny's 1,096-point gain. One stock the Reddit gamers loaded up on, manipulated, and caused this extraordinary casino move in the oldest stock index in the stock market. Charles Dow must be rolling over in his grave. Never mind all those old-timers who used to believe there was such a thing as Dow theory. What is unknown in this manipulation game is how much involvement the plunge protection team has taken to boost a false positivity. The manipulation shut down the potential Dow theory bear market signal. The plunge protection team would want that failure. Under the circumstances, while it makes for great narrative to the investment community to see the potential Dow theory bear market signal and non-confirmation with the industrials take place, the way it happened is not the stuff of confidence building for the future of the economy. The trucks are not running, the cargo ships are still unloaded, plane flights are still being canceled, etc. Smoke and mirrors are not the tent poles of reality. Here is the thing. A lot of margin debt was Tuesday to push Avis and the trannies higher. The problem for the Gamma Bull mems is if trannies as a whole drop, which will take Avis down with it, the margin calls will siren and a massive amount of selling must follow. This can cause a cascading plunge, with the MEMS traders getting their clocks cleaned. Schemes almost never end well, whether it's Ponzi, oligopolies of the residential real estate market, see REITs remember REITs in the 1980s and the saving of the loan catastrophe, for those that recall, subprime mortgage lending, Gamma Bull mem trading, or whatever. Meanwhile, American Airlines, a component of the Dow Transportation Index, announced on the same day as this Avis Gamma event that, quote, American Airlines cancels hundreds of flights after canceling thousands over the weekends. Go figure. The question is, how long can this go on for? Or is that the real question? The markets have tracked the expansion of the Fed balance sheet, which when taper ends, or sooner, when the Treasury starts to flood the market with new debt issues, which will add to liquidity reductions. The market, as we can see, is presently ahead of the Fed's balance sheet growth, which normally adjusts the market. However, we have major seasonality pressures that the market sees, in addition to equity inflows, again starting to resemble a tsunami. Maybe we should focus on the reality of what Congress has just dumped on us as an approved $1.2 trillion bill, which requires major new taxes for the wealthy beginning in January, plus taxes on the company's profit, which would take down the value of their stocks overall. Clearly, as Elon Musk just tweeted, the rich are grappling with what to do before everyone else does. Like an avalanche, it only takes one snowflake to set it off. The option games being played tells us that the market presently has no real support, as it has no real volumes. It will be a matter of who gets to the door the fastest. Maybe we should just remember what Stanley Druckenmiller had to relearn. Forget trying to make money here. Just stand aside. It is about reality, not illusion and delusion. It is about what we said at the beginning of this session. It is about 1, discipline, 2, risk-adjusted investing, and 3, reality versus delusion. It's now your choice on the type of investor or trader that you are or want to be. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as actually no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of go up dramatically. The powers to be are now effectively ring-fenced by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for education and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.